Right now, at this exact moment, a $14 trillion decision is being made by millions of Americans. And if you're a senior, a retiree, or anyone over 50, there's a very good chance you're making the wrong choice. Here's what nobody is telling you. The biggest financial mistake of your generation is UNT market crash. It isn't bad luck. It isn't inflation. The real mistake is something you can control, but only if you understand what's actually happening. In the next 30 minutes, I'm going to show you a mathematical truth that Wall Street doesn't want you to know. A truth that explains why people who invested in gold over the last 40 years have essentially stolen time from their own retirement. And more importantly, I'm going to show you exactly what to do about it, starting tonight. By the time you finish this video, you'll understand the one concept that separates people who become wealthy from those who just get by. And that concept is about to become the most important factor in whether your family stays financially secure or not. This video provides educational analysis and market commentary for informational purposes only. It does not constitute investment advice. Always consult with a qualified financial advisor before making investment decisions. Past performance does not guarantee future results. But first, let me ask you something. How many times have you heard this? You need to own gold. It's the only safe investment. Governments are printing money. Inflation is destroying your savings. When the economy crashes, gold will be your life raft. You hear it everywhere. On the news, from financial advisors, from friends who seem to have inside knowledge. And because it feels true, because you do see inflation, because the government does print money, because the economy has been uncertain, you believe it. I get it. I understand completely. You lived through the 1970s, or you saw what happened to people who didn't have any safe assets. The fear is real. The concerns are legitimate. So people do what seems logical. They buy gold, they feel safer. They think, at least my family has something solid, something real, something that will hold its value no matter what happens. But here is the problem. That logical decision might be costing you $2 million over your lifetime. Not exaggerating, not being dramatic, actually mathematically costing you millions. And the crazy part, you can figure this out in the next 30 minutes. You can understand why, and you can adjust course if you're willing to look at the numbers honestly. Here's exactly what's going to happen in this video. First, I am going to walk you through a thought experiment that uses one image to explain the fundamental problem with gold. You'll see it, and it will click. You'll think, why didn't anyone explain it this simply before? Then, I'm going to show you historical proof. Real investors, real numbers, real consequences. People who made exactly the same decision you might be making right now back in 1980. And I'll show you what happened to them versus people who chose differently. Third, I'm going to reveal the mathematical force that's about to reshape markets. Not a crash, not a headline. Something much more powerful. Something that's been building for 50 years and is about to accelerate dramatically. And finally, this is the important part. I'm going to give you 3 specific, actionable steps you can take starting tonight to position yourself on the right side of this shift. Steps you can implement in less than an hour. Now, here is what makes this different from the typical financial advice you hear. I am not going to tell you to be scared. I'm not going to tell you the world is ending. I'm not going to push you into any particular investment. In fact, this video is the opposite of fear. Instead, I'm going to show you that when you understand the real underlying mathematics of wealth, fear becomes irrelevant because the numbers don't lie. The math doesn't care about your emotions. And once you see it, you will realize that confidence isn't based on hope or faith. It's based on understanding how wealth actually works. Most financial advice plays on your fear and gives you a false sense of security. What I'm going to show you does the opposite. It might actually challenge your assumptions, but it will give you real confidence because you'll understand why the smart money moves the way it does. You'll understand why younger investors are making different choices than their parents. You'll understand why large institutions are quietly making massive shifts right now. Let me start with a simple question. What is gold? I don't mean, what is gold used for? Everyone knows. Jewelry, electronics, dentistry, all that. I mean, what is gold as an investment? If I gave you $10,000 worth of gold bars and I locked them in a vault and I came back in 10 years, what has that gold done? What has it produced? The answer, nothing. It's just sitting there, shiny, inert, unchanged. Now, if I gave you $10,000 worth of shares in a business, and that business invents products, serves customers, earns profits, and pays dividends, what has that investment done? Everything. These distinctions, this fundamental difference between an asset that just sits there and an asset that produces something is the bedrock of everything I am going to explain. Most people don't think in these terms. They think about gold as protection and stocks as risky. But that's emotionally driven thinking. That's fear-based. The reality is much simpler. And once you see it, you won't be able to unsee it. Picture this in your mind. Imagine you took every ounce of gold that has ever been mined in the history of human civilization. All of it. From ancient Rome to Fort Knox to your grandmother's wedding ring. Everything. You melted it all down into one massive cube. Do you know how big that cube would be? It would fit inside a baseball infield. You could walk around it in about a minute. That's it. That's all the gold that exists in the entire world. In one cube, the size of an infield. And now, imagine I told you that same cube is worth $14 trillion. What could you buy with $14 trillion? Here's why. This matters to you right now. That $14 trillion might include your retirement savings, might include money you thought was safe, might represent choices you've made based on fear, but more importantly, that number represents a choice between two different paths to financial security. Path A. You own a piece of that gold cube. Path B. You own something else. And here's the thing nobody talks about. 40 years from now, one of those paths will have made you wealthy. The other will have barely kept pace with inflation. One path will secure your family's future for generations. The other will have cost you millions without you even realizing it. The question is, which path are you on right now? In the next section, I'm going to show you the exact comparison that proves which path wins. And it's going to be so obvious, you'll wonder why every financial advisor isn't explaining it this way. But before I do, I need you to understand something. This is INA about being right or wrong about gold. This is about math. Cold, hard, undeniable math. So if you're willing to challenge your assumptions, if you're willing to look at the numbers and follow them wherever they lead, stay with me. Because the next part will change how you think about money forever. Okay, so let's go back to that $14 trillion cube of gold. And let's do something simple. Let's compare it to something else you could buy with the same money. This is where it gets interesting. This is where you'll see the choice clearly. Let's start the comparison now. Let me do a little thought experiment, and this is important. So I want you to really picture this in your mind. Imagine we took all the gold in the entire world, everything that's ever been mined throughout human history, all the jewelry, all the bars in Fort Knox, and every other central bank vault, every gold coin hidden in someone's basement, every gold tooth, every wedding ring, every piece of gold that exists anywhere on this planet. All have it. If you melted it all down into one massive cube, you would have a cube that is roughly 68 feet on each side. Think about that for a moment. 68 feet by 68 feet by 68 feet. It would fit comfortably inside a baseball infield. You could walk around the entire thing in about 60 seconds. Now, at today's prices, let's say roughly $2,000 an ounce. Give or take, that little cube would be worth somewhere in the neighborhood of $13 to $14 trillion. That's trillion with a TA, staggering, almost incomprehensible amount of money. $14 trillion sitting in a shiny yellow cube. Now, with that $14 trillion, what could you do instead? Well, for $14 trillion, you could buy all the cropland in the United States. Every farm, every acre of wheat fields in Kansas, cornfields in Iowa, rice paddies in Arkansas, all have it. And after buying all of that, you'd still have money left over. So let's keep going. You could also buy approximately 16 ExxonMobilis, or 16 companies of similar size, some of the most profitable, most productive corporations in the world. Companies that produce energy, that employ hundreds of thousands of people, that generate tens of billions of dollars in profits every single year. And after buying all the farmland in the United States and 16 giant corporations like ExxonMobil, you'd still have about $1 trillion left over. Walking around money, so here's the choice. And I want you to really think about this, because this is the heart of everything I am going to tell you today. You have two piles in front of you. Pile is the cube of gold, 68 feet on each side. $14 trillion worth. Pile B is all the farmland in the United States, plus 16 of the world's largest corporations, also worth $14 trillion total. Today, right now, they're worth exactly the same amount. The choice is yours. Which pile do you choose? Now, before you answer, let's fast forward and see what happens to each pile over time. Let's go to 100 years from now. The cube of gold will be exactly the same size. It will be a cube 68 feet on each side. It might be a tiny bit bigger if miners have extracted more gold from the earth, but your original Cuba gold you own will be unchanged. It will have produced nothing. It will have earned nothing. It will still be sitting there, inert, waiting. You can polish it. You can caress it. You can stare at it, but it will just stare back at you. Its value in 100 years will be determined entirely by what someone else is willing to pay you for it. Its value is dependent on the next person in line being even more scared or more excited than you are today. That's it. That's the entire value proposition. You're betting on someone else being more afraid than you are. That's all gold does. Now, let's look at pile B. Over 100 years, all of that farmland will have produced unbelievable quantities of corn and wheat and soybeans and cotton and vegetables. It will have fed millions and millions of people. It will have generated trillions of dollars in revenue for its owners year after year after year. The 16 ExxonMobils, or whatever great companies you chose, they will have produced staggering amounts of energy. or sold trillions of products, or built millions of devices that people wanted. They will have innovated. They will have adapted to changing markets. They will have employed millions of people, and most importantly for you, the owner, they will have paid out trillions upon trillions of dollars in dividends, money that flowed into your pocket every single quarter. Money you could reinvest to buy even more productive assets. Money you could spend to improve your life. And those companies, if they're well run, will likely be worth many, many, many times what you paid for them 100 years ago. Not just because of inflation, but because they will have grown, expanded, acquired other businesses, and increased their productive capacity exponentially. Pile A produces nothing. It just sits there. Pile B is a cornucopia of production. It is the engine of prosperity. It is the beating heart of wealth creation. Think about this very carefully. This simple comparison is the absolute bedrock for understanding what's going to happen next. The distinction between a non-productive asset and a productive asset is the most important concept in all of investing, and we are about to see that difference play out on a scale that will boggle the mind. Let me ask you something. If you had to choose today, if you knew what I just told you about 100 years from now, would you still choose the gold cube? Of course not. The answer is obvious, painfully obvious. Yet millions of people are choosing Pile A right now. They're choosing the sterile asset. They're choosing the thing that produces nothing. And they're doing it based on fear. Why? Why would anyone make that choice? The answer is one word: fear. Gold is the ultimate fear asset. When people lose faith in everything else, in their government, in their currency, in the stock market, in the future itself, they run to gold. It feels ancient. It feels permanent. It feels like something that will be there when everything else has collapsed. Commentators and salesmen understand this, and they play on that fear masterfully. They show you charts of government debt spiraling upward into infinity. They tell you that your dollars are becoming worthless. They say hyperinflation is right around the corner. They warn that the entire financial system is on the brink of collapse. And then they present gold as the only lifeboat, the only thing that will save you and your family when the ship goes down. Let me ask you something. Have you felt that pull? That little voice in the back of your head saying, maybe they're right. Maybe I should have some gold, just in case, just to be safe. It's a very human, very powerful instinct. And I understand it completely. I get it. The fear is real. But here's the thing I need you to understand. That instinct, that decision made out of fear, often leads you to make a terrible long-term financial decision. You are choosing to sterilize your capital. You are taking a portion of your wealth, maybe a significant portion, and putting it into something that cannot, by its very nature, grow or produce anything. It's like taking a brilliant, hard-working farmer and telling him to go sit in a chair in a dark room for the rest of his life. The potential is wasted. The opportunity is lost. The years are stolen. And that's exactly what's happening to millions of people right now. This historical example is critical to understanding the future, because what I am about to tell you, the event that is on the horizon, is the logical conclusion of this very story, but amplified 1,000 times over by the dynamics of the 21st century. Let's go back to the early 1980s. Picture this. It's 1980. You're an investor, and the world feels like it's falling apart. Inflation is raging at double digits. Unemployment is surging. Interest rates are through the roof. The economy is in complete chaos. gas lines stretch around the block. People are genuinely afraid. The consensus está, overwhelming, universal consensus is that you absolutely must own gold. Everyone is saying it. Financial advisors are saying it. The news is saying it. Your friends are saying it. Inflation is going to destroy everything else, they say. Gold is your only salvation. So in January of 1980, gold hits an all-time high of around $850 an ounce. The fear is palpable. People are terrified. Investors are panic buying gold, thinking it's their only protection. It feels like the safest, most logical decision in the world. An investor decides to put $50,000 into gold at that peak, at the height of fear. It feels right. It feels safi. It feels like the smart move. Now, here's where it gets interesting. What happened next? For the next 20 years, gold did almost nothing. It went down. It languished. It stagnated. It was one of the worst performing assets you could have owned. An investor who bought at the peak of the fear in 1980 had to listen to this 28 years just to get their money back. Not to make a profit, not to beat inflation, just to break even. Just to get back to that same $850 per ounce price they paid nearly 3 decades earlier. So in real terms, in actual purchasing power terms, that investor got absolutely devastated. They had turned their $50,000 into an asset that produced no income, no dividends, no cash flow. Zero. And they had to wait nearly 3 decades just to get back to zero. Think about that. 28 years. That's an entire generation. That's the prime earning and wealth building years of someone's life. Gone. Stolen by a fear-based decision. But that's just the gold story. Now, let's look at what happened if you made a different choice in 1980. What if that same investor, with the same $50,000, decided to invest it in the stock market instead? What if, despite all the fear and the chaos and the recession and all the doom-mongering, they put that $50,000 into the S&P 500? Well, by the time we get to 2008, that's 28 years later, that's $50,000. Investment would have grown to approximately $2 million. Not adjusted for inflation. Not theoretical. Actually, genuinely, $2 million. $2 million versus $50,000. That's not a difference of some percentage points. That's not a close call. That's the difference between retirement security and financial stress. That's the difference between leaving your grandchildren an inheritance and having nothing to leave them. Both investors started from the exact same place. Both felt the exact same fear. Both made what seemed like the right decision at the time. Both had access to the same information, but one path led to stagnation. The other led to generational wealth. And do you know what the difference was? The difference was choosing between a sterile asset and a productive one. Now, the stock investor didn't need to be a genius. They didn't need to pick winning stocks. They didn't need to time the market perfectly. All they did was buy an index fund that represented the 500 largest American companies. They just stayed in it, year after year, through recessions, through crises, through moments when everyone was panicking and saying they should have bought gold instead. They just stayed in it, and they became a millionaire. The gold investor did everything right. According to the fear-based narrative, they protected themselves. They chose the safe asset. They did exactly what the consensus told them to do, and 28 years later, they had to start over. Now, I need you to understand something. This isn't ancient history. This isn't something that happened 100 years ago. This happened to people who are alive today. Investors who are still retired, still living with the consequences of that decision. And here's the thing that really matters. The same situation is happening right now, today. In 2025, the fear-based narrative is exactly the same. Gold is the only safe thing. Stocks are too risky. The economy's on the brink. Buy gold for protection. And millions of people are making the exact same decision that the 1980 investors made. They're buying gold. They're putting their retirement savings into something that produces nothing. They're betting that the next person is going to be more scared than they are. They're stealing their own future. And in 28 years, some of those people are going to wake up and realize they made a terrible mistake, just like the 1980 investors did. But here's what's different now. Here's what's more important now than it was in 1980. In 1980, the difference between productive and non-productive assets was becoming clear, but it wasn't extreme. The divergence was visible, but not dramatic. A smart investor could see it. A curious person could understand it. But today, the divergence has accelerated. It's gotten dramatically more pronounced, and it's about to become even more extreme. The amount of wealth being created by productive businesses is compounding faster and faster. Technology is accelerating that process. Global markets are accelerating it. The digital economy is accelerating it. Meanwhile, gold is still growing at 1.5% per year, linear, unchanged, inert. The gap between them isn't just growing, it's exploding. And that explosion is about to fundamentally reshape markets in a way that 1980 investors never experienced. The person who makes the wrong choice today, the person who chooses gold over productive assets, aren't just making a mistake. They're locking themselves out of one of the greatest wealth-building periods in human history. Because what is about to happen is bigger than what happened between 1980 and 2008. It is more powerful. It's more consequential. And if you don't understand what's happening, you'll end up like the 1980 gold investors. Waiting, hoping, wondering why the strategy that was supposed to keep you safe actually robbed you of everything. Now, what I'm about to tell you is the most important part of this entire video. This is the event that's actually coming. Not the gold crash, not the market crash. Something far more significant. Most people think that a big event in finance has to be a single definable moment. A crash, a government announcement, a war, a headline. They're looking for something dramatic and obvious. But the biggest things in finance, the most powerful forces, are often silent. They are the slow, relentless, unstoppable tides of mathematics, not the noisy, crashing waves that get all the attention. The event that is about to permanently reshape markets isn't a headline. It's something else entirely. It's what I call the Great Wealth Divergence. And it's been building for 50 years. Let me explain what's actually happening right now in the world economy. For most of human history, wealth creation was limited. Yes, people got rich through conquest, through trade, through agriculture, but the rate of wealth creation was constrained. There were limits to how much you could produce, how fast you could grow, how much you could innovate. But something changed. In the last 150 years, and especially in the last 50 years, something fundamental shifted. Humanity unlocked the secrets of exponential growth. Technology, capitalism, global trade, digital communication. These forces created a gusher of wealth, an engine of production, unlike anything the world has ever seen. The value of the world's productive asset stocks, the bonds, the real estate, the private businesses is not just growing, it's compounding at an incredible rate. Every single year, these assets throw off trillions of dollars in profits and earnings, and a huge portion of that gets reinvested to create even more productive assets. It's a flywheel of creation, a virtuous cycle that accelerates. Meanwhile, what's happening to gold? Well, it's getting a tiny bit bigger each year. The world mines about 2,500 to 3,000 metric tons of gold annually. That increases the total supply by maybe 1.5%. That's it. A tiny, linear, arithmetic increase in a world of exponential creation. Do you see what's happening? The Great Wealth Divergence is the ever-widening gap between the total value of things that produce wealth businesses, farms, infrastructure, innovation, technology, and the total value of a thing that just sits there. Gold. For decades, this gap has been growing, but we are now at a point where the scale of it is becoming almost nonsensical. It's hard to even comprehend the magnitude. The amount of wealth being generated every single year by productive businesses now dwarfs the entire value of all the gold in the world. Let me put this in perspective. The S&P 500 has what we call an earnings yield. It estimates the total earnings of all the companies in the index, divided by the price of the index. Right now, that's around 4.25%. What that means is, for every dollar you invest in the S&P, American businesses are earning 4 to 5 cents for you, their owner. That money can be paid out as dividends, or it can be reinvested to grow the business even more. What is the earnings yield of gold? It's not zero. It's negative. You have to pay for storage. You have to pay for insurance. It actively costs you money to hold it. Year after year, you're paying money to have your wealth sit in a vault producing absolutely nothing. So the divergence is this. The world's productive engine is compounding positively. Gold is compounding negatively. Every single day, every single hour, the gap gets wider. The distance between them accelerates. And here's what's critical to understand. This gap is about to become impossible to ignore. Right now, most people are still operating under the old paradigm, the old fear-based model. Gold is money. Gold is insurance. Gold is safety. But technology and information flow are making the truth of this divergence more and more apparent. Younger generations of investors, those who didn't live through the 1970s, who don't carry that fear deep in their bones, who think differently, they aren't tied to the old dogmas about gold. They see a company like Apple that generates over $100 billion in free cash flow every single year. They see the gold cube that generates nothing. And the choice is obvious to them. It's a no-brainer. But here's the real catalyst. Here, what? S going to seal the deal and force this divergence to the forefront of everyone's awareness. Eventually, large pools of capital are going to do the math. Pension funds managing trillions of dollars, sovereign wealth funds, insurance companies, the massive institutions that have historically held gold as a just in case in case the entire system collapses, they're going to have their analysts and actuaries present them with spreadsheets. Cold, brutal, undeniable spreadsheets. The opportunity cost of holding gold, the drag-on returns, the loss of compounding potential year after year, decade after decade. And when they see those numbers, they're going to ask a question that nobody has asked for 50 years. Why are we holding this? Why are we holding an asset that costs us money and produces nothing when we could be holding assets that produce billions in profits? The answer is there's no reason. There never was a reason. It was just fear. Fear that became habit. Habit that became dogma. And when that realization hits, when those massive institutions start to understand this mathematically, everything changes. They're going to slowly and then quickly react. They're going to trade their sterile asset for a productive one, not because gold will crash in price necessarily. Gold might even go up in price. That's not the point. The point is that it will be the final official recognition that gold has lost its place in the modern portfolio. Its narrative will be broken. Its mythology will be shattered. It will be relegated from a primary asset, something serious investors own, as a core holding, to a tertiary one, a collectible like art or fine wine, a thing for a very small number of very wealthy people to own and admire, but not a serious component of a wealth-building strategy for the average person. This is the event. This is what's actually coming. The great secret of the gold market is that the gold market is a distraction. It's a sideshow. It's a story based on ancient fears, not modern realities. The real story, the place where fortunes will be made, is in owning the things that create, that produce, that innovate, businesses, productivity, compounding wealth. When the divergence becomes officio, when the narrative shifts at S, when you want to be on the right side of it, not desperate to catch up, not wondering why you waited so long, but already positioned, already invested, already compounding. The question is, are you going to be ready when that happens? Or are you going to be like the 1980 investors, realizing too late that you spent decades in the wrong asset class? Now that's all very interesting. Now, you might say, but what do I do about it? Theory is nicey, but I need practical advice. I need actionable steps that I can take starting today. And that's what I promised you. And that's what I'm going to give you right now. Here are the 3 specific steps to not only survive this divergence, but to put yourself on the right side of it. To harness the power of the productive engine for your own family's future. Step 1. Acknowledge your fear, but separate it from your strategy. It is completely okay to be worried about the future, about inflation, about government debt, about market crashes. These are legitimate concerns. You're not being paranoid, you're being realistic. So do this. Write down your financial fears on a piece of paper. Be honest. Get them all out of your head and onto that paper. I am afraid of my savings losing value due to inflation. I am afraid of a major market crash wiping out my portfolio. I am afraid that the government is irresponsible and the dollar will become worthless. I am afraid I'll run out of money before I die. Whatever your fears are, write them down. Looking at it in writing separates the emotion from the action. It compartmentalizes the fear. Here is the key insight. Your goal is not to find an asset that makes you feel less scared today. Your goal is to own assets that will build your wealth over the next 10, 20, 30 years. Regardless of what the headlines are saying, fear is a terrible guide for long-term financial decisions. It makes you reactive instead of proactive. It makes you chase shiny objects instead of building wealth systematically. It makes you rich in emotions and poor in reality. The productive path forward requires separating the two. Acknowledge the fear, honor it, write it down, but then make your investment decisions based on mathematics, not emotion. Step 2. Buy the engine, not the anchor. The single best thing that the vast majority of people can do is to consistently buy a low-cost S&P 500 index fund. Let me break down why. When you buy an S&P 500 index fund, you are not betting on a single company. You are not trying to pick winners and losers. You are not trying to time the market or outsmart professional investors. You are buying a slice of the 500 largest, most productive, most innovative companies in America. You own companies that are inventing the future. You own a piece of the farm, not the rock. You are harnessing the greatest wealth creation machine in the history of the world. And you don't need a lot of money to start. You can do it with $50 a month, $100 a month. Whatever you can afford. The key is consistency, which brings me to step 3. Step 3. Automate it and ignore the noise. The biggest enemy of the individual investor is not the market. It's not the crashes or the recessions. It's themselves. They buy high when they're excited. They sell low when they're scared. They chase trends. They panic during downturns. They get seduced by headlines. You need to take yourself out of the equation completely. Here's exactly how. Set up an automatic investment. Every single month, have money automatically taken from your bank account and invested into your S&P 500 index fund. The same amount every month. Come, rain or shine. When the market is up and everyone is excited, your fixed dollar amount will buy fewer shares. When the market is down and everyone is panicking, when the news is terrifying, when your friends are saying you should have bought gold instead, your fixed dollar amount will buy more shares. You will automatically be buying low and buying high in the perfect ratio. This is called dollar cost averaging, and it's the most powerful tool individual investors have. This strategy automated consistent investment into a broad index of productive American businesses, the most reliable path to wealth for the vast majority of people. It requires no genius. It requires no special insight. It requires no perfect timing. It only requires the discipline to stick with it. And it only requires faith in one thing, that the American economic engine, over the long term, will continue to produce, will continue to innovate, will continue to create wealth. And that, my friend, has been the single best bet you could have made for the last 200 years. And there's every reason to think it will be the same for the next 200 years. Now, let me be clear about something. I'm not saying gold is worthless. I'm not saying you should own zero gold. If you want to own some gold as a small percentage of your portfolio, 2 or 3%, a psychological comfort or as a hedge, that's fine. But I am saying that the large portion of your wealth should be in productive assets, in businesses, in the companies that are creating the future, not in a sterile rock that just sits there. So here's the great secret of the gold market. The gold market is a distraction. It's a sideshow. It's a story based on ancient fears, not modern realities. The real story, the place where fortunes will be made, is in owning the things that create, that produce, that innovate, businesses, productivity, compounding wealth. The coming divergence will make this clearer than ever before. Those who own the sterile cube, those who choose gold over productive assets will see their purchasing power stagnate. They all look back in 30 years and realize they parked a significant portion of their wealth in an asset that did absolutely nothing. Those who own a slice of the productive farm will see their wealth grow and compound in ways that will secure their family's future. Not just for them, but for their children and grandchildren. Don't let the fearmongers trick you into making a multi-decade mistake. Don't trade the dynamic, wealth-creating engine of American business for a shiny rock that just sits there. The great event is an awakening. And for you watching this today, that awakening can start right now. Tonight, you could set up your first automatic investment in the next 30 minutes. You could be on your way. Thank you so much for your time. If this video resonated with you, please like it. Please subscribe to the channel. Hit the notification bell so you don't miss our next analysis. And most importantly, leave a comment below. Tell me, what's been holding you back from investing in productive assets? Is it fear? Is it confusion? Is it just not knowing where to start? I read every comment and I'd love to hear from you. Remember, this is educational content. Past performance does not guarantee future results. Always consult with a financial advisor about your personal situation. But the mathematics of this divergent stats reality, that's happening right now. I'll see you in the next video.